Hello and welcome to the November 2023 Market Outlook webinar for SIA Wealth Management. My name is Colin Szynski, Portfolio Manager and Chief Market Strategist. Thank you all very much for joining us today. In this month's Market Insights, we are going to look at the recent upturn in equity markets. It's been a pretty strong bounce, and what we're looking at is considering whether it's a trading bounce or the start of perhaps a more sustainable rally. And there's a number of factors we'll look at: central banks, inflation, commodity prices, quantitative tightening, seasonality, cycles, concentration, and sector actions. So there's a lot to cover in this month, as there's a lot happening. Oops. There we go. One of the big themes we've seen since the beginning of this month is this rally really got going on the 1st of November after the Fed meeting. The Fed did not raise interest rates, and they were kind of neutral on how much more they were going to be doing. And we can see this is part of an overall trend that's emerged over the last 6 months or so since the summer, is that from about May to 22 to about June of 23, we saw the central banks around the world consistently jamming up interest rates. They were way behind the curve on inflation and had to catch up. Now they've kind of caught up, and now they've kind of all gone on hold. The one catch, though, however, is last week Australia actually raised interest rates again after a 5-month hold. And this is important because some people have been thinking, well, once the Fed stops raising rates, then they'll cut. But Australia shows us that may not necessarily be the case. So that's something we need to think of over the days and weeks and months ahead. Has inflation come down fast enough? Well, this week we saw a significant rally in the markets as we saw significant declines in the consumer price index. Now, in particular, as we look at this, we have the US CPI came down. The UK CPI, which is the green line, has come down quite fast as well. If we look on the right-hand side, though, to different inflation measures in the States, we can see consumer prices are coming down pretty quickly. However, they haven't gone to levels below where they were at in the summer. They were down, they kind of went down into the summer, then they bounced and they started to roll down, but we haven't hit new lows yet. So inflation, even the CPI, is still holding above 3%. The other measures such as wages, the hourly earnings, or the course PCE inflation that the Fed like to use, they are coming down, but at a slower pace than CPI. And the reason for that is the consumer prices are influenced by commodity prices more, and those have been moving quite rapidly. The talk out of central banks has been fairly hawkish of late. Last week, the Fed Chair Powell talked about Fed head fakes and inflation, and said they're still prepared to do more if they need to, or they're not. Several speakers, including Powell, have said that they don't think they've done enough to get inflation under control yet. And meanwhile, the flip side was Australia, and this headline here on the top right is the one we want to be careful of, which is the Australia thought it was done raising rates and it wasn't. So it's unclear at this point in time. The markets seem to be acting, as we can see here, like the Fed is done and they're ready to start cutting rates, and that may not necessarily be the case. So what we want to watch for now is, are we setting ourselves up for future disappointment in equity markets? But for the time being, at least, stocks are rallying, and we've seen some pretty nice breakouts here. We can see the Nasdaq was trending lower from July. It's broken out of that downtrend and has actually started to gap upwards. So what we're watching for now with something like the Nasdaq is, well, what happens if it gets back closer to the summer highs? That 14,400, 14,500 area could be resistance. Does it have enough to push through or not? At this point in time, it's hard to say. The big thing, of course, the shift in interest rates is Treasury yields have come down significantly, from 5% back to 4.5%, which is a pretty sizable pullback, and something we haven't seen of this magnitude since March. There's the old saying, markets go up like an escalator and down like an elevator. And if we look at the action in March and the action now, that certainly appears to be the case. Volatility has come down as well. In the October market correction, we had seen the VIX starting to climb, and it actually had poked its head back up above 20. However, we've seen it quickly roll back down below 15 again, back into this area of confidence perhaps complacency. It's a little early to say, but certainly we've seen fear in the equity markets has dropped off pretty rapidly as we've moved into November. Crude oil has also come down significantly, the price of crude, and that's helping the inflation story as well. We've seen crude oil drop back from the low 90s back into the mid 70s. Has helped the consumer price index in the US, the UK, and other countries to come down quite rapidly. The other thing that this has done is weigh on energy stocks as well. We've seen that in the later part of the summer, energy was one of the strongest sectors, and more recently, it's been one of the weaker sectors. And we'll speak to that again a little later in this presentation. Meanwhile, with all the focus on interest rates, something that's really important to remember is that the central banks are also doing quantitative tightening. That the flip side of quantitative easing is and increasing the balance sheets is that now they've got to shrink them back and get that back under control. And something that's important to remember is this is a multi-year process. And to achieve quantitative tightening, the central banks need multiple years of relative economic stability. They can't jam up rates too much and crash the system, and because then they'd have to come back in and undo their quantitative tightening. And that's quite important because then they start easing again, and potentially, and so it's important. And so we'll see from the Fed is when markets coming down too much or the economy starting to slow, then they might back off. And then when the economy is strengthening again or inflation is picking up, then they might get more hawkish. But the overall tone is likely one where they kind of need to be going sideways for a number of years to do that. We can see the Bank of Canada started trimming back its balance sheet in 2021. It started at just above $100 billion. It got up to about 575. It's come back about halfway to about 325, which is quite significant. But for them to continue, they probably need a couple more years to finish unwinding the stimulus of 2020. And this chart here shows the European Central Bank as well has started and they went from about just under 5 trillion in 2020 up to just below 9, and now they're back to 7. So similar to Canada, they've kind of come back about halfway. The Federal Reserve Board, however, has quite a long way to go. They started at 4 trillion in 2020. They jammed it all the way up to 9 trillion, and now they're back to slightly just under 8. So they're down moderately, but they have not come down anywhere near as much as some of the other central banks. So they've got a long way to go. And the older indicator that people would use as well is the adjusted monetary base as an example of whether the Fed was tightening or easing or what they were doing. And we can see here they ramped up in 2020, they ramped up again in 2021, they started to come off in 2022, but basically they've been flat this year. The adjusted monetary base has flattened, and that means that through the ups and downs of the market this year, the Fed has not actually tightened as much as some of the headline numbers might have us believe. And so that's important because that means that they still have quite a bit more work to do as we go forward. And they're actually, once again, behind the curve relative to other central banks. Something else, a few other financial measures we're keeping an eye on. Here's one that's U.S. bank deposits. And how much money are people putting in the banks? Well, here's something interesting because of course, it's when money flooded the system, the deposits soared from the beginning of 2020 to the beginning of 22. They kind of leveled off and started to come back down a little bit in 22. And then, of course, in March, we had a sizable drop off when we had banks going out of business and we had a run on the banks and banks getting into trouble. And so deposits came back down then. People were taking their money out of the banks. But what's interesting with this is that people haven't put their money back in. We don't know where it's going. Some people have suggested it's gone into money market and other places. But basically, bank deposits have not bounced back from March. So even though we've seen bank stocks start to bounce back, confidence in the banking system has not come back the same way. And one other one we're looking at with consumers is credit card delinquencies. Are people starting to get behind on their credit card payments? And as we can see, this kind of had been working its way downward over a decade, and even 2021 has continued to come down. But since the beginning of 22, it's been slowly and steadily climbing, and that has not changed, and that has continued to increase over the course of this year. One other thing we wanted to move on to now was market seasonality. We've seen a lot of historically traditional patterns play out for the most part this year. The red lines are 2022. The blue line is the long-term historical average. These are monthly returns for the Dow for each month going back to 1987. And then the green bars are 2023. And so what's important here was that we do have the markets kind of start off quiet. They pick up in the spring. They sell off, slide back in May, June, hence the sell in May and go away. You get a July bounce. August, September are often weak, and October can be all over the place. It can be an up or down month. And then you often finish stronger November, December. Last year, I call it seasonality on steroids, 2022. The strong months were incredibly strong. The weak months were incredibly weak. This year, we've also seen the markets generally follow the historical seasonal pattern, but the swings have been more moderate than in 2022 for the most part. And we look at an October, as September, October as examples, even August, we can see that in 2022, big sell-offs in August, September. This year, more moderate sell-offs in August, September that actually continued into October. Last year, the bounce started in October. This year, the bounce started November the 1st. And so far, we've seen gains in the first half of November already equal to the entire month of November last year. So November is off, definitely off to a significantly strong start. Something else we're watching for, and I mentioned this a little bit earlier with the NASDAQ, is we're now watching to see, is this a trading bounce or is this the start of a breakout? And the indices, we look at the S&P 500 has yet to break out. It's just kind of in this sideways range. It's moved up, but it hasn't broken out yet. So we're watching to see if that actually breaks out or not. And an interesting one here is the Russell 2000 also has not broken out. It's still stuck in its sideways range. It has bounced up off the bottom of this sideways range, but we can see that it hasn't even rolled over into a next column yet. That would require a gain of 6% or more up off the lows, and we haven't really had that yet. So it could be close, and we could see it any time, and that would be significant. But again, with the Russell, we're looking at a bounce within a range to date. And what's interesting about that also is that we've seen the NASDAQ run, and that's kind of these large cap, magnificent 7 stocks that were have been the darlings of the market all year. And we've seen the S&P pick up, and we haven't seen the Russell pick up yet. But if it starts to, that would be positive. A move up by the Russell would be a sign of increasing market breadth, of reduced concentration problems, and that we're not just 7 stocks, but we're actually into a broader market advance. Would be quite a significant signal. Wanted to continue with this theme of the presidential cycle and the Dow. We started to look at this because Q3 historically is a pretty strong year for the markets, and the first half of this year things were going pretty well. And then in the third quarter we had a correction, a 2.5% decline for the Dow. And then we're like, okay, well, what happens in Q4? Well, historically, a negative Q3 was followed by a positive Q4, and that the markets tended to. In the 3 cases this happened before, the markets clawed back all of their previous losses and then some. And so 2011, 2015 were similar. They basically clawed back their Q3 losses in Q4. In 1999, we saw the markets have claw back all their losses and add more. And we're starting to see that so far in this quarter, where the markets have moved up, have clawed back all their losses and moved up higher. So that's quite significant. The one we continue to watch out for is if something were to happen and this were to reverse. The one quarter where we did see a decline, a year 3 Q4 decline, was in 2007, and that was right as things were heading into a fairly significant bear market. As it is, year 4s over the last 40 years or 30 years have been fairly volatile, as we can see. We saw in the 1999 column, 2000 was quite volatile, 03 was quite volatile, 08 was quite volatile, 2012 was very up and down as well, and 2020, the last cycle, had that huge sell-off in the first quarter, and then a huge liquidity-driven recovery after that. Historically, year fours have been quite volatile. For which way we're setting up, we might get an idea as we see markets continue to play out over the course of the current quarter. Similarly, just looking at the cycle and the equity action call, we can see that if we look back at presidential years, 2004, the markets held in the green zone, but 2008, 2016, and 2020 were all presidential fourth years that had and coincided with a trip into the red zone. The 2012 did not, although there was a dip into the yellow zone, but we do note that there was a red zone in the fourth quarters of 2011. So it's possible that that one might have been pulled forward a little bit. We're looking now, the only other red zone we've seen that wasn't in a year four was last year in 2022, when we had that bear market due to a rapid rise in interest rates and a shift in the inflation and monetary cycle. So as we looked at this, concentration being a problem has eased off. It's pluses and minuses. This is looking at the OEX members of the S&P 100 index. We can see year to date to November the 10th, 20 out of the 100 stocks were above the index return. That's down from a peak of 26 at the end of March. This is just looking at quarterlies plus November the 10th as the most recent. The number of stocks with a positive return has kind of bounced around 50, between about 48 and 58 really, and in the last couple of weeks this has bounced. At the end of September it was actually under 50, and similarly the median return for the S&P 100 index has also bounced back a little bit. At the end of September, it was actually negative. Now it's back up to 1.6%. But that 1.6% median return is still a far cry from the 24% return of the index. So it's pretty clear that most of this index return has been driven by a small number of stocks. And if we look at the divergence here, the average return year to date of the best 10 stocks is 98%. The average return to date of the other 90 stocks is 1.75%. So this index return is very much getting distorted by a very small number of stocks. And we've seen this divergent fact that the average of the best 10 stocks keeps increasing and the average of the worst 10 stocks keeps getting worse. So the difference between the two continues to widen. And the average of the worst 10 stocks right now is a loss of 26.4% for the year. So we're definitely seeing that the S&P 100 is still an index that is very much dependent on the returns of a small number of stocks. And we'll look at looking at sector scopes activity as well. These are we use this called the sector scopes. It measures the percentage of stocks in 31 different sectors that are on a bullish trading signal. When the sectors are on the left, it's indicative of a weak bearish market, low bullish percent. The right side is high bullish percent. So if we look here at the end of October, we can see most of the sectors were kind of piled up on the left. It was a declining market, a bearish market, and borderline oversold market. And the strongest sectors at the time were energy and utilities, followed by aerospace. And on the weak side, we could see things like manufacturing, semiconductors, autos, and so on. And now if we look to November, we've had a huge shift, big shift to the right. And that's indicative, of course, of a market rally, of a bullish market, a market that has bounced back in a lot of sectors that were on bearish bullish percent or low bullish percent have now become substantially higher. So in fact, some of the names we've seen, construction has gone from very left, the leftmost column actually to the rightmost column. Construction has done extremely well, driven by the home builders. On the other hand, we've seen energy go from the right side way over by itself over on the left side. Some of the defensive sectors, healthcare and drugs, are kind of dragging a little bit. Auto has been dragging because while the strikes are getting resolved, but transports have picked up a little bit. And the strongest ones after construction, if we look at the second column, we've got in here things like computer software, electronics, and semiconductors. So that's kind of the high beta sectors. But we've got banks, we've got utilities, and that's an indication that the interest rate sensitive sectors also are picking up as we've seen Treasury yields come down. We've seen that bounces in bonds. We've seen the US dollar back off. We've seen interest rate sensitive sectors picking up. So that move in the Treasury yields has had a wide ranging effect across asset classes and across sectors. Speaking of sectors, looking at the returns over the last month or so, as I mentioned, that's the third column here from the of the numbers, and so we can see decline of 4.1% and 1.4%. Respectively for energy and healthcare. So energy has struggled with the decline in oil prices. Healthcare has struggled with has just been lagging. And we look at the 3-month column to the right of that, and we can see in fact that healthcare has been the worst performing sector of the last 3 months, and the second worst has been consumer staples. So even though markets have been up and down, these historical defensive sectors have really struggled of late. The stronger sectors we've seen in the last month, industrials have roared back, financials, we've seen real estate, utilities, tech, so we're seeing that the cyclicals and the interest sensitives have really been the ones that have been driving and participated in this market rebound. And I was debating whether to include this slide or not. It's one that I often do, but I started to see some chatter about people talking about, oh, well, now the Fed can start cutting rates next year. Well, the thing is that if the Fed starts suddenly cutting rates, as I mentioned, they need stability for a long period of time to get their balance sheet back down. So if they suddenly have to start cutting rates substantially, it means they're in a recession, the economy is tanking, and there's real trouble out there. And that's what we've seen historically, that under the be careful what you wish for, in the past when interest rates have peaked, they've often shortly thereafter been followed by a peak in the stock market and a substantial bear market. So the Fed funds peaked in June of 2000. The Dow Jones peaked in December of 1999, but the S&P peaked in September of 2000. And then the Dow Jones didn't bottom out to September of 2002. Now this is monthly closes, so it's the low month rather than the actual low day. June 07, the Fed funds peaked. The peak month was October of 07, bear market through to 09, market went down 50%. That was almost double the 2000 to 02 bear market. Fed funds peaked in April of 2019. Dow Jones peaked in December of 2019. Now, despite the fact, obviously, this bear market was accelerated by COVID and shutdowns and everything else, the market did bottom out with still a 23% decline top to bottom. And we just highlight here the 2022 bear market, which was actually in a rising interest rate environment, so a little different. Again, a decline of about 20%. So while the central banks are continuing to fight inflation, while they're continuing to get their balance sheets back under control, it's important for us to remember that if they suddenly have to turn around and hit the panic button, that there's reasons for that, and that may not necessarily be a good thing. So we're keeping an eye on all of these different factors as they move through the system. So that concludes most of my prepared remarks. We will include here our fund codes for the funds where SIA Wealth is a sub-advisor to BMO Global Asset Management. There's the focused Canadian and North American equity funds. There's also the tactical global equity and tactical global asset allocation funds. And so that concludes this month's webinar. We'll be back in December with another market outlook, and we certainly expect it certainly looks as though we could be in for quite a bit of volatility in the coming weeks. We've got U.S. Thanksgiving up, we've got Black Friday coming up, and of course into mid-December we have another round of central bank meetings as well, where we might get more commentary on monetary policy. So at this point, we hope you all have a good month and have a great day.